Hey everyone, welcome back to the channel. Let's get straight into it. This time we're talking about something that people love from their portfolios, and that's dividends. But not just dividends, we're talking about dividends often. See, a lot of traditional dividend portfolios pay every quarter, which means that you'll see income 4 times per year from each position or holding. And there's nothing wrong with that. But some investors prefer building a portfolio that produces more frequent income. We're talking about monthly dividends or even weekly income. So in this video, I want to walk through a dividend portfolio idea that focuses on 3 things: stability, reliable dividend income, and frequent payouts. Now, this portfolio is dividend focused, not growth focused. That doesn't mean that there's no growth potential, but the goal here is really income and stability. Also, a quick disclaimer and reminder: I am not a financial advisor. None of this is advice. Instead, what we're doing here is just walking through an example portfolio idea for entertainment purposes only. With all that said, let's get started. So the idea behind this portfolio is to combine a few different dividend strategies together. We're using dividend growth ETFs, high yield dividend ETFs, monthly dividend stocks, covered call income ETFs, and even a small weekly income position. Here's the stock selection and allocation amounts. We're going to do 25% to SCHD, 25% to SPY-D, 25% to Realty Income, 20% to Devo, and then 5% to Chippy. Each position plays a specific part in this portfolio. So the foundation of this portfolio is going to be consisting of 2 different ETFs, SCHD and SPY-D. Together, they're going to make up 50% of the portfolio. This is going to be the core and stability layer. Both of these ETFs focus on large established companies that already have strong dividend histories. They also both pay quarterly dividends, which is the traditional dividend schedule most companies follow. SCHD focuses on high-quality dividend companies from the Dow Jones U.S. Dividend 100 Index. These are companies with strong balance sheets, consistent dividend histories, and strong cash flow. A lot of dividend investors like SCHD because it balances dividend income, growth, and long-term stability. Now, SPY-D is a little different. SPY-D focuses on the highest dividend-paying companies within the S&P 500. So instead of focusing heavily on dividend growth like SCHD does, SPY-D leans more into high-yield stocks from the S&P 500 index. Together, these 2 ETFs give the portfolio broad market exposure and diversification, along with high dividend companies, dividend growth potential, and consistent quarterly income from 2 different assets. This is the foundation of the portfolio. Next, we move to the part of the portfolio that focuses on monthly income. The first holding here is Realty Income. Now, Realty Income is actually known as the monthly dividend company, and that's because it pays dividends every single month. Realty Income is a REIT, which means that it invests in real estate properties that generate rental income. Many of these properties are leased to major companies like Walgreens, Dollar General, FedEx, and more. This makes Realty Income a really popular choice for dividend investors because it offers consistent monthly income along with real estate diversification and a long history of dividend payments. So it adds another income stream that pays every month instead of quarterly. Now, the next holding gives monthly distributions as well as Realty Income, but it adds another income strategy with covered calls. This one is called Devo from Amplify. Now, Devo is a covered call ETF. What that means is that the fund holds a portfolio of high-quality companies, but also sells call options on some of those positions. Those option premiums generate extra income for the fund. That income is then paid out to investors as dividends. So the strategy here is essentially own strong companies, generate income from those options, and distribute that income to investors. This allows Devo to pay monthly dividends while still holding on to companies that investors already know and recognize. The trade-off, though, is that covered call strategies can limit upside during strong bull markets. But for an income-focused portfolio, many investors are okay with that trade-off. Now, the final position in this portfolio offers something a little different than the other holdings. This one is called Chippy from YieldMax. Now, Chippy is designed to generate income through an options-based strategy. One thing that makes it interesting is that it pays weekly distributions. This is very different from traditional dividend stocks, but it's important to understand that funds like this can carry higher risk especially because they rely heavily on option strategies. That's why in this portfolio, the allocation is only at 5%. The idea is to limit exposure to a riskier asset. Instead, it's used as a small income booster that also introduces a weekly payout schedule. When you combine all the different holdings together, you create a portfolio that gives you distributions much more frequently than a traditional dividend portfolio. Here are how the payouts break down. You're going to get quarterly dividends coming in from SCHD and SPID. You're going to get monthly dividends coming in from Realty Income and Devo. And you'll get weekly distributions coming in from Chippy. So instead of waiting every 3 months for most of your income, the portfolio is designed to generate dividends throughout the entire month. Even though this portfolio introduces some complex income strategies, you got to understand that the majority of the portfolio is allocated into more stable dividend investments. 75% of the portfolio is into SCHD, SPID, and Realty Income. These are widely known dividend holdings used in many different dividend portfolios. The remaining 25% is where the income strategies come into play with Devo and Chippy. This balance helps the portfolio stay focused on income without taking excessive risk. This type of portfolio is really designed for investors who prefer dividend income over growth and want to mix the traditional dividend investing with income strategies. It may not be the perfect portfolio for someone who's purely focused on maximizing long-term growth, but for income investors, this structure can make a lot of sense. Now, one thing I want to mention is that with a portfolio like this, the allocation amounts really aren't set in stone. One of the benefits of building a portfolio like this is that you can adjust the percentages depending on how aggressive or conservative you want to be. So for example, if you wanted a slightly more conservative version of this portfolio, you can increase the weight of the more stable dividend ETF. So instead of 25% to SCHD, you can move it up to 35% of the portfolio. That version could look something like this: 35% to SCHD, 25% to SPID, 25% into Realty Income, 10% into Devo, and then 5% into Chippy. In this version, you're increasing the portion of the portfolio that focuses on dividend growth and stability. Now, on the other hand, if someone wanted to make this portfolio more income focused, they could increase the allocation to the income strategies. That version might look something like this: 25% to SCHD, 20% to SPID, 20% to Realty Income, 25% to Devo, and then 10% to Chippy. This version would likely produce higher income, but it also introduces a little bit more risk because of the larger portion of the portfolio that would rely on option-based income strategies. So the key takeaway here is that the portfolio construction is flexible. You can tilt it more towards stability, higher income, or somewhere between depending on your goals as an investor. Look, at the end of the day, dividend investing is really about creating a portfolio that matches your goals as an investor. Some investors focus on dividend growth, some focus on high yields, others focus on generating income as frequently as possible. This portfolio is an example of combining multiple dividend strategies together to create a steady and frequent income stream. And like always, it's important to understand what you own and why you own it. Anyway, with all that said, if you've enjoyed the breakdown of this portfolio idea, or you like the stocks that we talked about in this video, then please make sure to like, share, and subscribe for more weekend-friendly stock content like this. It really helps my channel out a lot, and I'll be really appreciative of you. And let me know what you think about the portfolio in the comments section. I'll catch you in the next video. Take care.